Let's dive deeper into the action with our markets reporters. Abigail, what are you watching at the close?
Caroline, I'm on record watch and no go. The S&P 500, here's a year-to-date chart. You see a nice uptrend, kind of choppy. Now, earlier today, we were less than 5 points from the S&P 500, taking on its closing high and a little bit more from its all-time high. But you can see here at the close, not quite making that mark. However, very close, so perhaps tomorrow or next week. It is worth noting, however, Taylor, take a look at the brutal range beneath the S&P 500 right now, shown by that 200-day moving average in pink and the 50-day moving average in yellow. If the S&P 500 really can't climb significantly higher, we could see more of this year's choppy action trading go on. But worth noting, up 20% right now, on pace for the best year, Taylor, since 2013.
Well, Abigail, for me today, it is all about the bond market. And I was really interested in both the 10 and the 30-year yields today that are rising about 5 basis points or so. And that means the 2s, 10s yield curve is re-steepening. We're now at about a 5 or 6 level. And that is very different from 2 weeks ago when we were looking at this yield curve that was inverted. So at least today, we're getting that classic risk on feel with some yields on the long end really starting to rise, re-steepening that 2s, 10s curve. Now, interestingly enough, though, the trend has been very different. If we take a look at a weekly view, come into my Bloomberg terminal here at GTV Go, we're taking a look at TLT, which is long-term duration bonds. And this is, of course, on news that we got headlines that U.S. high-grade bond funds put in their third largest ever bond fund flows, now at $5.6 billion. That's the highest level going back since April. So, of course, TLT here now has a record amount of shares outstanding, highlighting, at least in the past week or so, huge demand for high-grade bonds. Mike?
Well, Taylor, it feels like people have been predicting the next recession basically since the day after the last recession ended. But obviously, the forecasts have really picked up lately since the yield curve inverted and the manufacturing PMIs around the world are in contraction territory. Today, we had Jeff Gundlach saying there's a 75% chance of a U.S. recession before the next election. Bloomberg survey of economists puts it at about 35% in the next year. And everyone's got their favorite recession indicator, but there's one that not a lot of people talk about that I wanted to bring up. And this comes from Nick Colas at DataTrek Research. He pointed out to me last week how at least the last few recessions have always been preceded by a major spike in oil prices. If you look at that chart, oil on a year-over-year basis basically doubled at least before or at the beginning of the last 3 recessions. And if you look at that chart, it shows that's not the case right now. Oil's down about 20% on a year-over basis. Now, obviously, no recession signal, or at least anything that's purported to be a recession signal, is perfect, especially when it comes to timing when that recession may start. But, Joe, at least this one, imperfect as it is not signaling a red flag of a recession coming up.